Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
All right, Tim, give me a test 1, 2, 3, 4, 5.
Test 1, 2, 3, 4, 5.
All right, good deal. Here we go. 5, 4, 3, 2. And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planner, CFP, Tim Stearns, president and founder of TJ Stearns, Inc., your resource, ladies and gentlemen, for guidance and insight, for direction and perspective on your money, helping to unclarify the complicated financial world so that you can put your money to work for you to help you achieve those important financial goals. And Tim, we always appreciate the time and the information and knowledge that you share with us.
Peter, thanks for having me.
Always a pleasure, Tim. Now, today on the minds of savers and investors is probably the recent instability that we have seen in the market.
Absolutely.
I would say that some of it's predictable. I mean, we've seen a fantastic run up in the market, pretty stable climb for the last decade, and we're maybe a little overdue, plus a lot of additional pressures on the market right now. So are you hearing people being concerned? Are you hearing questions or worries about the market in your business day to day?
Yeah, especially the people who are in your rank and file, mutual funds and that type of thing that, they don't have stop losses involved. They're not actively managing their money, that type of thing. We're seeing that quite a bit.
Now, just because we see market volatility, Tim, does not mean that we should stop our financial progress in any way out of worry and out of fear. Caution is always prudent, but fear should never be the driver of financial decisions, should never be controlling the direction of the vehicle, so to speak.
Well, I mean, if you have a plan and, you understand that some of your assets will be at risk, and there's not much you can do about that. But there are certain, barriers that you can put up that will, stop you from losing all of your money. So back in 2008, a lot of people are forgetting that they lost a third of their portfolio, up to even a half, I've seen. And now they're starting to see this thing creep back in where you can actually lose money in the market. And there's a kind of a reality check there. So, we've told people, that's why you have an annuity or you have something that's uncorrelated, cash, other, commodities, that type of thing that are not correlated to the market. We see people coming in here all the time that have all correlated assets, for example, bonds and stocks. And what you're seeing is that, when the Fed raises interest rates, that's bad for bonds. It's an inverse relationship. It's not an if, it's a when. And when you see that, you need to do something about that, and get ahead of it. We've been talking about that on the show forever. People have forgotten that the market can pull back, and it has nothing to do with what's going on, maybe in the stock market, but other things in the world. You have Russia is a factor. All these different things happening with that. The Fed, what are they going to do about inflation? There's another thing that we don't have control over. But if you're well planned out goal is that some of your assets are going to take some bumps and bruises. It's okay because you have an income allocation plan, but most people don't have that.
Well, if recent market volatility has been of concern for you, ladies and gentlemen, pick up the phone and give a call to your resource, a certified financial planner that can perform that forensic financial analysis and give you a better understanding of your money, the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how much risk you do have inherent in your life savings. That's important for us to know before we see a precipitous fall in the market or any kind of pullback. We want to limit the amount of money that is on the table that we could potentially lose. And Tim Stearns helps to formulate those plans that will work hard to achieve your goals, but also limit the amount of risk that you have on the downside. That's the benefit of having a planner, having a relationship with a certified financial planner, CFP, with the tools and the access to the tools that Tim Stearns has. If you'd like to set up a time to speak with him, have that forensic financial analysis, have that written protect and grow plan, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Now, Tim, in our conversations before the program here, you were actually sharing some pretty staggering stats on the percentage of Americans that do have that written plan, and then how it correlates to the confidence in financial future for many of us.
Another thing, though, with these people that do have a plan, 42% of them say that they have a retirement plan, but they don't have a plan done in writing. And my point is in my family, my mom has always been in charge of the finances, and my dad passed away 8 years ago. But if roles had been reversed, he would not know what was going on. Luckily, my mom does and has a good handle on it. I also say she has a great financial planner, right? So me. But anyway, my point being is that you have to have a plan, and you need to let that spouse know what your plan is. So not having a plan is having a plan, as we've talked about before. Another interesting statistic is that since COVID, over 51% of Americans feel like COVID has hindered their ability to have a successful retirement plan. And that's scary.
Well, I could see that, Tim. I mean, it has added a lot of additional pressures, not only the healthcare related events themselves, but a lot of the workforce transitioned or changed. There was a lot of unexpected retirements that occurred. There's a lot of people that changed their retirement timeline. And then for those that continued on as planned and thought that they were going to be retiring here in the near future, their dollars are worth significantly less now. So the compound effects of inflation on trying to be confident that our money's going to last have really increased the difficulty of retiring.
Yes. I mean, we've never had more people call me and say, hey, can we get together? I think I want to quit in the last couple of years. We have, I always talk about our one client. He had 4 different bosses in the past year. And he finally just had it. And he said, can we get together and redo our income plan? I was going to last a couple more years in the job, but it's not working for me. Life is too short. If I need to get a job just to have some benefits like health insurance, I'll do that. But let's see what it looks like. That's the nice thing about having a written income plan that's dynamic, because, life comes at us pretty fast and you need to be able to move and shake with it. And at the end of the day, that's what's helped a lot of our clients get to a successful retirement.
Well, I saw a recent news article, Tim, that basically said we are experiencing the great resignation, that more people are leaving their jobs, in most cases voluntarily, but it was not on the timeline originally intended. And then, yes, we want a quality of life, but what does that do for our projection for financial stability and confidence?
Exactly. I mean, and, I think you can't really put a price on happiness. And with these people, having to work from home or not having the social aspect anymore of work, they're not motivated, or they are sick of their jobs, and the job has changed underneath their feet while they're working because of COVID. These are things that we're seeing a lot of. People are unhappy and they're getting out of their jobs and maybe hanging it up for good or not. But the only way you're going to know if you can do that is by doing a written income plan. And that's why we're happy to help people.
Get that plan put together, ladies and gentlemen. That is one of the most valuable opportunities that you have here on the program. Not only the education and the information, but the hands-on planning approach, the assistance of a certified financial planner, and to sit down, crunch the numbers, design, and get in writing that protect and grow plan and that written retirement income plan. That can give you a lot of confidence if you are considering making that transition or even have recently done so. Pick up the phone, give Tim Stearns a call, 800-640-2256. That's 800-640-2256. And Tim, I have seen some of the results of some of these plans you've put together make a swing in several hundreds of thousands of dollars over someone's lifetime, from the Social Security reports and analysis that you do to the tax analysis and comparison to the risk assessment and the fees that people are paying. All of these can make a measurable impact. Now, you make this opportunity available with no cost. Similar reviews and those reports and analysis can go upwards of $1,000 to several thousands of dollars in some cases for similar types of reports. You do not charge anything for that service, but it can literally make the difference in a swing in several hundreds of thousands of dollars over the course of our retirement lifespan.
Exactly. I'll give you an example. Last night, I was at a birthday party for one of my friends who turned 50. And I overheard a woman talking about how she was going to turn, she was 61. She's going to turn on Social Security at 62. She has absolutely no plan. And after I talked to her, but she didn't realize that she'd be getting 75% for the rest of her life of what she could have received. She thought that when she turned age 67, that it would turn back onto her full amount. And I said, no, you're totally incorrect. Have you done a retirement Social Security optimization report? And she had not. And so the software that we use, we can literally show people if you're leaving money on the table, or if you're taking money too early, or if you should wait a little bit. These are things that are all encompassing when you do a written income plan.
Well, that's money that you're either going to be able to count on and rely on or generate from Social Security, or that you're going to have to be responsible for generating from your personal savings, your investments, and your retirement accounts. So that part of it alone, ladies and gentlemen, worth the time that you would invest in getting that Social Security optimization report. Again, pick up the phone and give a call. Tim Stearns, the team at TJ Stearns Inc. will walk with you through that process. It's not a painful process, quick and easy, takes about 30 minutes to an hour of your time crunching the numbers, and it can make a significant difference in your financial outlook for retirement. 800-640-2256. That's 800-640-2256. So Tim, we did start off the program acknowledging the recent instability that we've seen, some of the volatility in the market. The year got off to a little bit of a rough start. January was not a fantastic month. February was rocky as well. Downturns in the market happen, though. So we know that that is going to be a natural state in the market from time to time. What is the right approach when we do experience market volatility?
Well, one of the things that we'll do is we talk to people about, what hurts as far as, can you lose 10% and be okay? Can you lose 15%, 20%, or go back to 2008, over 36% on average? So we have those conversations with our clients because we want to make sure that they understand the road could be rocky at certain points for some of your assets. It doesn't all have to be like that. That's why we always remind people, especially in our retirement rescue classes, that, if you're over 59 and a half, chances are your company will allow you to do an in-service distribution. Your profit sharing component stays the same, whatever they're giving into your 401k account, and your deferral stays the same. But you can take out assets and move them into other investments that you're not beholden to just what your company offers. That is a great opportunity. If your advisor has not talked to you about that, give us a call and we can tell you all about how it works. There's no taxes on it. You move it into an IRA. I mean, it's the best of both worlds.
The in-service distribution. Tim, do I continue to receive the match after I do such a move?
Absolutely. Everything stays the same and your deferral stays the same.
So again, if you'd like to find out about that in-service distribution, definitely something that probably people could have benefited from who retired right before any kind of major downturn in the past. Right. Unfortunately, we don't know when those downturns are about to happen. Usually we don't have that kind of crystal ball or forethought, but probably just means that if you've got that ability, if you've reached that milestone, it's a good time for you to look at it and consider it with the unknown future that we all have financially. So again, if you would like to learn more about the in-service distribution, make sure you're crossing all the T's, dotting all the I's, and doing it correctly so that it does not cost you anything, no taxes, no penalties for making that move, and that you're establishing the account the right way when you set it up for retirement. Pick up the phone, give certified financial planner Tim Stearns a call, 800-640-2256. That's 800-640-2256. So Tim, it sounds like the question shouldn't be, will the market go down again into the future, but rather, what will I do? What do I need my money to do when the market goes down into the future? And that may be a very individual answer. If you're younger, it may be that that's a significant advantage for you, that you are contributing and depositing and investing during those downturns. But if maybe we are around retirement age or already retired and we are making withdrawals, it may be a very different set of consequences if we experience that.
Right. I mean, and you're basically talking about sequence of returns risk, which I cannot get over how many people don't know what that concept is. The concept's really quite simple, but people don't know it. The definition, basically, it's when you retire into a bull market, chances are your retirement will go rather well. If you retire into a bear market, you could have issues where you could run out of money, or you're drawing off too much that you can't go and do those things that you wanted to do. We talk about that in our class. And again, most people, whether we're doing the classes in Tampa or we're doing the classes in Phoenix or Chicagoland, people are, oh my gosh, what's the sequence of returns risk? And that's scary. If I'll kid in the class and I'll say, if you know when there's going to be a bull market, retire then, right? Well, no one can be a soothsayer on that and know when that's going to be.
Well, Tim, so the question would be, if I believe that the next few years may be rough, we may see some turbulent times and we may experience a bear market, should I then delay retirement? Is that the solution?
Sometimes, unfortunately, it's too late to answer that question because you're already in the throes of it. The average bear market takes about 1.5 years to actually settle down, right? People don't realize that. It's not like one day the market goes down 36%. It's the ebb and flow and the ebb and flow, and then next thing you know, it's ebbing more than it's flowing. And at 1.5 years later, you're in the throes of it and you don't realize it. That's why, hopefully, before that happened, you went and did something and got an annuity, cash on hand that you don't have to draw down on your stock portfolio when it's been taking its bumps and bruises.
I think that we suffer a little bit, Tim, from recency bias, meaning that we tend to psychologically believe that the most recent experience that we've had is the experience that will always occur into the future. And we've seen this fantastic decade over the last 10 years with just a couple minor hiccups in there, one being coronavirus that bounced back so quickly. And so I saw a lot of stories after the Great Recession about how the younger generation was really gun shy and they were not taking the risk necessary. They were not investing because that was their experience. And then it seems like over the last few years, I've seen a lot more stories of people taking a lot of risk with the market. It's that recent experience that sort of gives us our outlook on what we believe we can expect. However, the recent experience with the market has not always held true. It has not been the experience over time with the market.
Well, yeah. And I see that with a lot of people gun shy to go in, when the younger ones, and then you have the older ones, they come into our office. And the next thing you know, they've got 70, 80% in stocks and they're about to retire. My Lord, that's way too much risk to have on the table. And they're in rank and file mutual funds that when the market goes down, they're going to go down like a hammer. And, and we've tried to explain that you need to, have things in there, maybe some stop losses, maybe some active management that will, if it breaks a barrier, you're going to go to cash. If you're just sitting there and doing a buy and hold when the market's so going down precipitously, you are in trouble. And the market, for example, in March 20 went down 24.2% on average. Right. Why ride it all the way down to have to try to come back up? And, by them propping up the Fed, propping up the stock market, you actually have this crazy inflation that we have now. So now what? It comes with good and bad, right? So you have to be careful of all that.
Well, again, if you would like some help navigating this interesting time that we live in financially, and make sure that your money is doing the work that it needs to support your quality of life and financial confidence moving forward, you need a plan. You need a written plan. You need the Protect and Grow plan and the written retirement income plan. And Tim Stearns, a certified financial planner, will help you put that together. All you need to do is pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, we intended to talk on this program a lot about fact versus fiction and separating what has actually happened versus what we've sort of been taught and come to expect with the market. We may have to push a handful of these off to another program, but I do want to get into it a little bit, because there's a wide perception out there that we can expect this 10 or 12 or double-digit rate of return when we invest in the market. What is the reality behind that? Or is that a reasonable expectation?
There's a wide expectation from, of 10 to 12% of growth in the market. But if you look at the average growth of the S&P for every complete 15-year period from 1996 through 2021, it was only 5.03. So you have to be careful to talk about these double-digit returns. A lot of people come in here with I'll call it an illustration, a hypothetical of their growth of their stock market, and it goes like a straight line to the moon, right? If anyone has a stock portfolio like that that's done that, I would love to have them manage my money. It doesn't happen. We ebb and flow. There's pullbacks and there's going forward. But at the end of the day, again, 1996 through 2021, 13 years of that's a bull market, right? The average was 5.03.
What's fantastic about the market, Tim, is that every time it does dip, it doesn't just come back. It comes back and then grows above and beyond. And it has done that historically. So over time, it is a great tool for growth on our assets, but we can't ignore those downturns as if they don't matter or as if they're not impactful, especially if we are counting on that life savings that is invested and affected by the market for our income.
Yeah, exactly. So you have to be real when you're looking at your returns. When we do an income allocation plan for people, the Department of Labor has said when you're doing a income allocation plan to assume a 4 or 5 at most 6% return, 6% being aggressive. We usually tell people just let's go 4%, and see how we do. And usually, if they've done their homework and they've done the right things, and with our portfolio, they're going to be okay, and they'll have a 30+ year retirement.
Well, I do want to note that if we assume that a plan is going to make 10 or 12%, and then we in fact only achieve or accomplish 5.78, let's call it 6%, as we have over the last 21 years, that the outcome becomes increasingly divergent over time. Right. If it happens maybe 1 year, that's not a huge impact potentially, but over the course of decades, which retirement can last, that's going to significantly alter our outcome and our trajectory, Tim.
Right. So you look at 2000 through 2021, the S&P only generated 5.78%. Couple that with 2 times the market pulled back 50% in that 21 years. That's one thing, when you're maybe in your, like myself at age 50, because I'm going to have at least 15, 17 more years of work. Correct. Well, at the end of the day, if I'm about to retire and I have a 50% pullback, I have issues. Am I going back to work? Am I asking my wife to go back to work? Are we getting a side job? Stuff like that. No one wants to go back to work if you've retired.
Now, I'm going to play devil's advocate here a little bit, Tim, and say, hey, you included the decade from 2000 through 2010. That almost never happens. That's an anomaly. We had 2 big rough patches in that time. But Tim, bear markets aren't as rare as people tend to believe or would like to believe.
Exactly. I mean, they're about every 6.5 years, round that up to 7 years. We're at 13 years. We're due for some pullback. There's been over 16 bear markets over the lifetime of the stock market. So, are we due for one? I would have to say yes, especially with the things that are going on in our world. Inflation is super high. Fed has to raise rates to get that under control. That's going to hurt bond funds. It goes on and on. There's a lot of things affecting you that you might not realize.
And a bear market, by the way, defined as a 20% loss or more in a market or index value. And those 16 bear markets that Tim mentioned, actually on average, they've lost about 39%. So reflect on that, ladies and gentlemen. What would you do? How would it impact your outlook of financial security if we did experience a bear market, 20% to 30%? Or more of the market value lost? How does that impact your portfolio? Would you be comfortable with those results or your financial outlook thereafter? There are alternatives. You do not have to experience the full swings, the full risk, the full losses of the market. That's what the Protect and Grow plan is all about. Putting mechanisms in place and a strategy that Tim Stearns can help to detail for you, show you the pros and cons, and fully explain so that you are informed and educated, but that will help you make forward progress without taking the significant risk of loss of being fully invested in the market. And as we move through our financial future, we are certain to see up times in the market and down times. Let's make sure that we are identifying opportunities, capturing gains when they are available, but also protecting what's important. That is the Protect and Grow plan. If you'd like to sit down with a certified financial planner and get answers to your questions, do that forensic financial analysis to understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how to optimize your retirement outlook and sources of income, such as Social Security and or pensions if you have one, pick up the phone and give Tim Stearns a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, as always, a fast-moving segment of the program. That's all the time that we have, but we always appreciate your guidance, insight, and the information that you share when you visit with us.
Peter, thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.